Welcome, boys and girls, to the Liberty Call for Thursday. What is this? February 10th, 2022. Hope everybody's having a fantastic day. I apologize for being about an hour late. Had some errands I had to run and do, and I had a conversation with a client. So talking about what's going on in the world and just shooting the stuff. Keep it clean. So again, I hope everyone's having a terrific Thursday out there. It's another beautiful day here in Colorado. It was a little hazy this morning, but the sun is out. The sky is blue. The snow is still in my front yard. So anyone who wants to come and help shovel it, you're welcome to come do so. But we'll get some more snow and it'll just pile back up. So if it's your first time watching, please click the subscribe button wherever it is, right? Probably down there. And give me a thumbs up and also share with friends and family. I would greatly appreciate it. I try to spread the message of liberty and responsibility and staying on top of your finances and making good financial decisions. But there's always somebody else out there that I could help. So if there's someone who might get some value out of the ramblings that I do every day, feel free. So, all right, well, let's take a peek and see how the markets did today. The Dow Jones, kind of a whipsaw day. We were in the green most of the morning, and then turned red as we hit the afternoon session. The Dow Jones was down 1.47%, closed at 35,241. S&P 500 was down 1.81, closed at 4504. NASDAQ down 2.1%, closing at 14,185. Small caps are down 2.04%. The VIX was up 19.79% today, up to 2391. Again, I talk about this every single day. 20 is kind of the target we want to be below. And, it's kind of been, volleying back and forth. If 20 was like the net in tennis, it keeps back and forth across those two thresholds. Looks like the European markets were kind of mixed. Nothing, too high or too low in any one direction. Same thing with Eastern Europe. And across the Asian markets, looks like Australia and New Zealand. Australia was up. New Zealand was flat. Japan was up. And kind of split. Shanghai was up. The SE component was down. China A50 was down. The DJ Shanghai was up. So kind of a mixed day across the markets. And looks like here domestically, we probably had it the worst. So again, certainly not the end of the world when it comes to the markets. I would probably suggest to folks out there, be prepared for some volatility, more in the negative direction. This is not financial advice, but I mean, it's anyone looking at the situation. I look at things from a law of probability. It is, based upon what's going on right now. Do we think markets are going to go have a greater likelihood of them going down or going up? Well, based upon a weakening dollar and the amount of inflation and the amount of debt, I'm leaning towards more of the downward trend. But hey, I'd like to be pleasantly surprised and see the market, just stay on an uptrend forever. But I don't see that that's probably going to happen. All right. Oops, hit the wrong button. All righty. First article I got here, S&P 500 slips as Fed's Bullard rate hike call rattles stocks. It's written by Yassine Ibrahim from investing.com. All right, let's dive in. The S&P 500 fell sharply Thursday after Federal Reserve officials stoked fears of aggressive rate hike of an aggressive rate hike. Spending, excuse me, hang on one second. Pardon me, had a frog in my throat. Sending Treasury yields soaring just as data showed inflation climbed to multi-decade highs. The S&P 500 fell 1.8%. The Dow Jones Industrial Average slipped 1.5% or 526 points, and the NASDAQ fell 2.1%. St. Louis Fed President James Bullard threw his weight behind the idea of the Fed hiking rates 1% by July after consumer price inflation that jumped by more than expected to 7.5% for the 12 months through January, the fastest pace since 1982. I'd like to see 100 basis points in the bag by July 1st, Bullard said in an interview with Bloomberg. I was already more hawkish, but I have pulled up dramatically what I think the committee should do. Bullard also suggested that he would be in favor of the Fed hiking rates in between meetings, which caught the markets by surprise as it signals that the Fed may be becoming more worried about inflation. Melissa Brown, managing director of applied research at Contigo, an index and analytics provider, said in an interview with investing.com on Thursday. The quarter point increase was certainly priced into the markets, with Fed futures markets implying about a 90% probability recently, but I'm not sure that a half point or more frequent quarter points were priced in, Brown added. Bets on the Fed hiking rates by 50 basis points next month jumped up to 89.9% from 24% a day earlier, according to investing.com's Fed rate monitor tool. The 10-year Treasury yield jumped 5% to top 2% for the first time in more than 2 years, drawing a bout of risk aversion across stocks, with tech bearing the brunt of the pressure. So let's see here. Apple, Alphabet, Meta Platforms, Microsoft, and Amazon edged more than 1% lower. There were some positives in the markets, however, as the parade of quarterly earnings from corporates continued to mostly impress. Coca-Cola was up 0.5% after reporting fourth quarter results that topped Wall Street expectations, though a weaker than expected outlook for the current year amid inflation pressures kept gains in check. PepsiCo also delivered a beat on both the top and bottom lines, and also flagged concerns about rising input costs for the year ahead. Its shares were down nearly 2%. Walt Disney, meanwhile, was up more than 3% after reporting better than expected quarterly results, underpinning the strong growth in its park business and upbeat subscriber numbers. Yeah, I saw a lot of that on the news, or on the business channel earlier today. They really were talking about how Disney had outperformed. A lot of it had to do with their subscriber base with Disney Plus. The success of shows like The Mandalorian, Book of Boba Fett, which I haven't watched. I've been waiting for it to finish. So I'll probably watch that this weekend now that it's all done. So there are definitely some good some good spots there in the market. Management continues to expect that net ads in fiscal year 2022 will be higher in the second half versus the first half of the year, which potentially suggests upside to consensus estimates. And we see the strong programming slate as justifying another price increase over the coming quarters. So it looks like they're going to raise some prices. Uber Technology slipped 6% despite better than expected quarterly results, and a ride-hailing company talking up the prospect of being free cash flow positive before the end of the year. In other news, Affirm stock slipped 21% on Thursday after the company tweeted out its second quarter results ahead of schedule. So it's kind of a mixed bag with the with the stock market right now. This next article, oil's big comeback rally snuffed by big U.S. rate hike fears. It's written by Bharani Krishnan from investing.com. It looks like the oil rally isn't immune to the fears of U.S. rate hikes, especially if they're going to be big hikes. St. Louis Fed President James Bullard not only delivered a kryptonite to the stock market on Thursday with his call of 100 basis point rate hike by July if the central bank doesn't succeed in making a ding in inflation running on 40-year highs. Bullard also practically kicked oil's comeback rally after 3 days of dreary performance in crude markets, triggered by concerns that Iran may be able to end U.S. sanctions, blocking some 1 to 2 million barrels daily from Tehran. Until Bullard spoke in a Bloomberg News interview on Thursday, markets had been pricing in a maximum of 50 basis points for any rate hike the Federal Reserve will be doing this year. That the voting member of the Fed's federal FOMC would push for an increase double than telegraphed to the markets was unnerving enough to Wall Street that it reversed a 1% rally on the S&P 500 earlier in the day, sending it down 1% instead. I think it finished down 1.5%. The oil rally, which had operated quite independently of the stock market for months by following its own bullish demand drivers, got pulled down as well as this time. New York traded West Texas Intermediate settled up just 22 cents or 0.3% at 89.88 per barrel, despite the January reading for the U.S. Consumer Price Index showing new highs since 1982. WTI rallied more than $2 earlier in the day, reaching a session peak of 92.74. That was, of course, before Bullard's comments. London traded Brent, the global benchmark, settled down 14 cents or 0.2% at 91.41. Brent rallied to as high as $93.06 earlier. Week to date, both WTI and Brent were down 2% each. So that is good news that, maybe a snuff of the oil rally could be a good thing, could be a bad thing. It's a little too soon to tell, but the inflation we're dealing with certainly is not good. All right. U.S. consumer prices post largest annual gain in 40 years. Weekly jobless claims fall. All right. The U.S. consumer prices rose solidly in January, leading to the biggest annual increase in 40 years, or in inflation in 40 years, fueling financial market speculation for a 50 basis point interest rate hike from the Federal Reserve next month. The broad increase in prices reported by the Labor Department on Thursday was led by soaring costs for rents, electricity, and food, and could heap more political pressure on President Joe Biden, whose popularity has been declining amid anxiety over the rising cost of living. We'll just call him Jimmy Carter Part 2. High inflation has overshadowed a strong economy, which grew at its fastest pace in 31 years in 2021, and a labor market that is rapidly churning out jobs. While this report on its own might not trigger a 50 basis point inaugural rate hike from the Fed, the pressure will continue to mount if inflation doesn't begin to roll over this spring, as policymakers anticipate, said Sal Gauthier, a senior economist at BMO Capital Markets. The consumer price index gained 0.6 last month after a similar increase in December. The food index rose 0.9, while the cost of food consumed at home increasing 1%. There's strong increases in the prices of cereals and bakery products, dairy, fruits, and vegetables. Meat prices rose moderately. Well, meat 2 years ago was up through the roof. So, the fact that whole cuts of meat aren't going up at the same rate right now is probably a good thing. Electricity prices jumped 4.2%, offsetting a 0.8 decline in the cost of gasoline and 0.5% drop in natural gas. In the 12 months through January, the CPI jumped 7.5%, the biggest year-on-year increase since February of 1982. 82, that was a kind of a crappy year. I was in second grade, so I was in Miss Turner's class at Whitcomb. Didn't like her very much. She was real nice to my son when he had her, but not my favorite. Anyways, back on task. That followed a 7% advance in December and marked the fourth straight month of annual increases in excess of 6%. Economists polled by Reuters had forecast the CPI rising 0.5% this month on a month and accelerating 7.3% on a year-on-year basis. So they were off by 20 basis points. Effective with the January report, the CPI was reweighted based on consumer expenditure data from 2019 to 2020. The economy is grappling with high inflation caused by a shift in spending to goods from services during the COVID-19 panic. Trillions of dollars in pandemic relief fired up spending, which ran against capacity constraints as coronavirus sidelined workers needed to produce and move goods to consumers. So, yeah, see, here's the problem with that. I know they're trying to shift this blame from, it was the pandemic and people not working and supply constraints. The inflation is primarily due to inflating the currency. You can go look it up in the dictionary. What is the definition of inflation? It is inflating the currency. It has nothing to do with cost of goods. Prices going up could be a supply and demand factor, but inflation is a separate animal also. All right, next article here. Hey, it has to do with inflation. Shocking. Inflation's at a 40-year high. 10 tips from the pros on how to invest and save during times of high inflation. So figured this would be good for those out there who, I try to do my best with what I manage, but at the same time, lots of people have lots of other assets, just cash, savings, things like that, gives you, this will hopefully give you some ideas of what you can and can't do, or what you could and should do. Number one, invest smartly in your employer-sponsored retirement plan. Investing is a key to beating inflation. For example, the average annualized return of the S&P 500 is roughly 10%. Data shows it's lower than that. That's why Stephen Carrig, certified financial planner and private wealth advisor at Integrated Partners, advises investing in your company's workplace retirement account and open a brokerage account for additional savings that you can view as your mid to long-term savings. Take advantage of the compounding. Not a bad idea. Number two, consider TIPS. TIPS are Treasury inflation protected securities, are government bonds that will help protect you from inflation. The principle of a TIPS increases with inflation and decreases with deflation, as measured by the Consumer Price Index. Weigh real estate and commodities. Gray Shung, certified financial planner at Midtown Financial Group, tells MarketWatch picks that tangible assets such as real estate or commodities are something to consider during times of inflation. As Morningstar recently noted, on the commodities front, in 2021, natural gas, oil, and broad commodities baskets have led the commodity universe in the year-to-date returns during a period where inflation fears have mounted. So, think about value stocks in the consumer staples arena. Snigdha Kumar, sorry if I messed up your name, head of product operations for Digit, says investing in things like food and energy, which are always in high demand, is a smart choice because staples are essentials and companies selling them have the ability to price items higher when riding the wave of inflation. Look for tax efficiencies. Look for tax efficiency in your brokerage account, which will help combat inflation, says Carrig. To maximize tax efficiency, investments that tend to lose less of their returns to taxes are better suited for taxable accounts, while those that lose more of their returns to taxes should be designated in tax-advantaged accounts. Essentially, if you want to keep more of your money tax efficient, investing will minimize your tax burden, which means you'll pay less on what your investments earn. Number 6, look at companies that can raise prices relatively easy without harming the business. Warren Buffett has long been a proponent of investing in businesses with low capital needs, particularly during times of inflation. Seek out companies that have an ability to increase prices rather easily. Buffett also wrote once, if you can invest in a company that's able to raise their prices without any loss of revenue, Buffett encourages doing so because it creates profit. Number 7, don't keep an excess of cash on hand. If you're someone who keeps a large amount of liquid cash on hand beyond what you might need for an emergency fund, then you should consider investing the excess. The stock market is low right now. It's not that low, but over a long rough time frame, that investment can earn much higher interest rate in the stock market than it would in a savings account. That said, don't neglect your savings. An emergency fund is key. Open a savings account and put 3 to 6 months of expenses there. That stays in cash and is only for emergencies. Though most rates on savings are low right now, it's much better than to earn some interest instead of none at all. And so for that reason, consumers should keep an eye out for high-yield savings, high-yield online savings accounts, which tend to offer rates that are much higher than the industry average. Number 9, go deep into what you spend and how you can save. When inflation is high like it is, you often get hit with higher prices everywhere from the grocery store to the gas pump. So keep tabs on your budget and follow a spending plan to keep track of your funds every month. If you're spending money in places that are enjoyable but may not be essential, taking a break or pausing this type of expense can lead to savings in unexpected places. And number 10, do not panic. Yes, inflation is high, but if you're investing, cost cutting where you can, and avoiding, if possible, highly inflated items, you're a step ahead of many others. Good advice. And this last article, I'm not going to read through it. It had a nice chart here of the best and worst assets during inflation. And it shows the inflationary return of these, and then also a representative ETF or investment that correlates with it. So starting out, at the top is oil. Its inflationary return. And let's go back. These go from periods of inflation post 2000. So looks like they probably cherry picked some timelines there. But oil has done the best with a 41% return during inflation. Emerging market stocks, like your small and undeveloped countries, 18%. Gold, 16%. Cyclical stocks, 16%, and so on. Your tips, which we talked about earlier, up 13% during that time. And let's go down to the bottom. High yield fixed income is probably the best of your bonds. Your investment grade fixed income would have lost 5% during that time, and your emerging market fixed income would have lost 8%. So you can see it's a pretty big spread from -8 to plus 41. Maybe this will give you some ideas as far as maybe some shorter term investments, maybe some places to put it, whether or not it's gold, silver, real estate, whatever it might be. But figured this would be a little helpful for those out there. So, all right. Well, I hope everyone has a terrific Thursday. I've only managed to ramble for 20 minutes, even though I try to keep this short. So, all righty. Well, hope everyone has a fantastic evening, and I'll be back tomorrow with the weekly wrap up, wrapping up the week in the market and any other news items that seem important at the time. So, hope everyone has a great evening, and I'll see you tomorrow.